welcome to Lawline with your host, David Schnurman, accomplished entrepreneur, attorney, and legal educator. Each week, Lawline will bring you the most knowledgeable experts in the field of law, business, and education. And now we introduce our guest and our host, David Schnurman.
Hi, welcome to Lawline. I'm David Schnurman. The economic outlook for the United States and the world is dire. The dollar is weak, the U.S. economy is close to insolvency, Greece is in economic turmoil, and China is growing at a rate that cannot be sustained. Our guest is Roger Arnold, a national recognized economist, radio talk show host, and experienced real estate executive. Roger, thank you for being here.
Thank you.
Roger, I had the pleasure of seeing you speak about a year ago, talking about the financial crisis. You talked about what was going on in the economy, and you gave a lot of, I would say, the word dire predictions of what's going to happen in the future. And it was such a great speech in kind of 2 hours where we kind of reviewed it. I figured I would go through some of the stuff that you discussed and see where we're at today.
All right, let's do that.
As well as educate people on a lot of the stuff that you said.
Okay.
You had said in 2008 during the Fed bailout, the Fed increased its books from $850 million to $2.5 trillion, and that the loans have pretty much all been written off, and that will lead to problems. And if you can, you talked about the M1 money supply and the M2, and why there was inflation and non-inflation. If you can kind of explain what the difference between the two is, and where we're at in terms of are the banks loaning money now, and if there is inflation or deflation in either money supply.
Certainly.
And if you don't know what we're talking about, he'll explain it. It sounds more confusing than it is.
It really does. As a matter of fact, in the media, we have a tendency to make these things sound even more complicated than they really should be. But in general, the M's, there's one called MZM, which is money zero maturity, one called M1, one called M2, and one called M3. And they are simply kind of stacked on top of one another. Money zero maturity is essentially cash, is what it is. M1 is very short-term securities. M2 and M3 are essentially a measure of money supply that is then created by the banks. Right. Or in other words, if I can, MZM, money zero maturity, and M1 are principally reflected of what you and I put into the banks, are deposited,
right.
You know, your checking account, your savings account, things along those lines.
From what I understood, M1 you were saying also is the money that the Fed gives the banks.
Exactly.
Deposits in the banks.
And that's the money, plus the money the Fed puts in.
Which is most of the money.
Money you and I put in, and then the money the Fed puts in when they need to. Deposits into the banks in order to get the banks to lend. Once you get to M2 and M3, you are reflecting the banks multiplying the money the Fed has put in. This is how fractional reserve banking works. And that's where you get your big jump in money supply.
And from what I understand, fractional reserve banking in simple terms, if you put in $1 million, the banks can loan out up to $10 million of that.
About 10 times that, yeah, that's right.
Essentially, they're printing money to expand the money supply, which is why, if you think about it, all banks are essentially bankrupt from the get-go because there's more money they're giving out than they have.
In the terms that most of us are familiar with, yes. The idea that the banks actually, you know, you've heard your parents tell you, wouldn't it be nice if money grew on trees? You know, if you're a banker, you don't even have to wait for it to grow on a tree. You literally just create it out of thin air. Boom, boom, book entry, right, just on the computer. That's the way the Fed creates theirs, and then the banks take that money and multiply it again and create their own money supply that way. And that's, the idea is when the Fed puts that in for them to do that. So the nice way to think about it is the Federal Reserve, your central bank, is really like remember the old analog stereo tuners where you had the fine tuner, which was very small, and the big tuner to get the knob to move from one end to the other?
Very few people remember that and laugh.
Right, exactly.
I do.
Well, the Fed is really supposed to be a fine tuning system, not a big tuning system. It's the banks that create money supply, not the Federal Reserve. The Fed creates the opportunity or the potential for that to occur. But that's the primary difference between the MZM and M1 on the one hand and M2 and M3 on the other.
So essentially the $2.25 trillion that was put in, let's just say that for simplest terms they were deposited in banks. What you were saying was, at least last year, and I don't know how much you say it's changed, that $2.25 trillion was not being lent from the banks to the public. So there was no M2 money supply being given out. And there was actually deflation, even though the government is saying the concern is inflation.
Yeah, if we were to get into exactly what's on the books of the Federal Reserve, now it's a fascinating conversation. We can go as far into this as you want to. I know that you have a limited time frame.
And we'll try to keep it simple so someone who's watching this will say, okay, I get where he's going here.
Putting aside the crisis, okay, before it started, the Fed's balance sheet, the value of the assets on the books of the Federal Reserve was about that $850 billion we were talking about. So in relation to some large banks, it's actually very small. This is where you get to that fine-tuning system that we talk about. But they can actually create money at will,
as they did.
And they did. Right. The question is, what did they do with that capital once they created it? And what they did was they removed from the banking system questionable loans, or loans that could not be sold. There was a liquidity crisis. And so the idea was, we will take illiquid loans from the banks, put them on the Federal Reserve books, and replace them with dollar bills, or essentially zero coupon U.S. Treasuries is what a Federal Reserve note really is. And then the banks are supposed to be able to lend that money out and multiply it, and the economy grows again, and then the Fed can figure out what to do with all these junk loans they have.
Are banks lending money now, from what you understand?
Right now, no. They weren't when we had this conversation, or I did that presentation a year and a half ago. They still are not. This is a real problem in the United States. Since you and I had this last conversation, we've gone through quantitative easing 1, and then we went through quantitative easing 2, which is just
printing more money.
It's essentially printing money, right out of thin air.
Right.
And then put it in the banks and pray that the banks create loans with this money, and it just hasn't happened.
So let me add to that, and we'll hold that one aside for now. There was a point where the stock market went down to 6,000 points.
Yes.
And what you had said was the reason it was able to go back to 12,000 or wherever it is so fast was all this M1 money that was put in banks and investment banks. What did they do? They said, okay, well, let's go gamble. And they went to the stock market, and all of a sudden there was a lot of money put in there. What you had said here, and I can quote it to you, said this 6,000 mark, you believe not only will the stock market, is it posed to topple, it will go below the 6,000 mark because all of that money was in there. If you can, I'm sure there's a lot of people sitting at the edge of their seats trying to understand where you think the stock market's going.
The 6,000 mark you're referring to is for the Dow Jones Industrial Average, which is just really 30 companies. The S&P 500 typically trades on average about 1/10 of that. So about the Dow would be at about at any rate, 10 times that level. So if the Dow in March of 2009 went to the years get screwed up,
I know, it's
I'm a macro guy. But at any rate, the S&P got down to about the 600 level, and it has since bounced up off of those levels. It's about doubled since then, and principally that has occurred because of the money flowing into the banks by the Federal Reserve. The banks have a decision to make. We can lend this out, which is not a unilateral transaction. If I make a loan to you, I then have to pray that you pay it back to me. I can't just call it due. If I instead take this money and swap it unilaterally for another asset that I can close out at any time, it's much safer for me to do that. I can go buy gold. Gold goes up. I can buy silver. I can buy oil. I can buy stocks. I can buy bonds. You can do anything, and then when you decide you want to close that trade out, you can reverse it without having to ask permission. If you make a loan, you have to essentially hope that the people pay it back. That is what has driven up the capital market, stocks, bonds, commodities. Currencies we'll put aside, and real estate we can put aside. It's an annoying, we can talk about that if you want to. Okay. But that's principally why we've seen commodities and we've seen equities and bonds go up.
You had said that you think the stock market is poised for a tremendous fall. Do you still believe that?
I do. I am not as convinced of it as I was then. I've been very impressed, quite frankly, with not only the size of the run-up in the stock market from the lows, doubling over the course of the past 2 years or so. But even in the face of the shocks to the system we've felt since then, 2 rounds of quantitative easing, the housing market still collapsing, European banks having problems, sovereign debt issues, everybody so far is holding themselves together. I've been very impressed with it. Now, having said that, I am still of the opinion that something is going to cause this process to reverse, and that you will get kind of like the game of spoons or Jenga, where once some of the big players get out, you're going to have a stampede of everybody else trying to get out. So,
well, let's move on to the next thing that may cause this.
Okay.
You said the next huge problem that we will face is the commercial real estate market. There's something like $3.5 trillion in debt that's going to become due in the next year or two. The problem is the banks that would refinance that was Bear Stearns and Lehman. They were the two major organizations who did commercial debt, and Goldman has, you said, 40% of commercial debt right now. You said there will need to be, if there's no one to refinance these loans that are coming due, there will need to be a massive bailout to prevent the commercial real estate market from toppling. How do you feel a year later based on those statements?
I got to tell you, I'm somewhat perplexed. We're not out of the woods yet. But ironically, New York saw a huge plunge in lease rates for commercial property. High-end properties we're talking about, and I thought, okay, I might have talked about this a year and a half ago, did I? And my take was that this was the precursor to kind of this self-sustaining crisis. As the loans come due, the cash flow that the buildings are drawing in will not allow the loans to be refinanced, and you're going to see massive defaults. It hasn't happened. One of the things, very interestingly, that's occurred is these loans, they've not been refinanced, but they've been extended. Now, that's a very interesting discussion to have in itself, because most of these loans are backed by commercial or were sold into commercial mortgage-backed securities that have bylaws specifically precluding extensions. Okay, but many of them actually went through, or the process was put through bankruptcy for some of them, and in other ways, it appears as though some super legal system has been developed where everybody said, if nobody does anything,
we're good to go.
We're just going to let this thing keep coasting, and that's really what's going on in the commercial real estate market.
Kind of like what George Bush said, he had to go against the capital system to fix the capital system. So all bets are off when you need to fix what's broken. So it seems like you're saying you're a little bit more optimistic than you were a year ago.
I'm cautious. David, we still got huge problems. Huge problems that could cause some of these things to become undone. But I will tell you that what I was very convinced of when we spoke about this, which was that this was going to have some sort of a crisis. Yeah. It didn't mean the values had to collapse, but that there were going to be legal issues, that this was going to have to run through the courts, very similar to what's happened on the residential side, and it has not happened. Sure. I've been actually very impressed that the borrowers and the lenders and the property managers and everybody seems to have been able to get together and said, listen, this is going to get real expensive if we don't figure this out on our own. And so far it looks like they have. Yep.
People are being people, and you got to figure out a way to survive. Money, economics has actually nothing to do with money. It has to do, you got to figure out how the building has to be owned by somebody, and you have to figure out who's going to do it and who's going to own the loan, so you make it work.
On the commercial side, by the way, New York is kind of one of those markets everybody follows. It's kind of, in the commercial real estate market, it's kind of as goes New York, so goes the rest of the country. And so far, New York has performed much better than I was anticipating at this point in time.
So for the real estate attorneys watching this and the business owners and tenants who are sitting in their seats and trying to determine the next couple of years in New York, do you think that rents will still go down or will go up? With
the rents are showing signs of going up in New York. They plunged. Yeah. And I mean, they plunged just a couple of years ago. But they have shown signs of stabilizing, and high-end rents are actually going up faster, which is what you really want to see. Sure. And that leads the rest of the market. So, we're not out of the woods yet, but really what's going on so far is almost without, I shouldn't say almost, it is without precedence. Legally, this thing was heading straight down a path that looked like it was going to be inevitable. These things were all going to wind up in courts, but so far it hasn't happened. So there have been a couple of bankruptcy cases, and everybody else looked over and saw them and said, let's just bypass that system because that's where we're going to end up going anyway. So it looks like New York has rebounded, knock on wood.
We'll talk about one more point about the U.S. that you talked about, and then we can get into kind of what's going on today before we go international. Insolvency. you had said the last time the U.S. was close to being insolvent was right after World War II, where GDP went above 140. It was about 147%. And you had said that, well, that's what we use now as the precedent. If you go above 140%, you're going to go insolvent. That's the closest you can get as a country. That's kind of the standard that's looked to.
On a global basis,
on a global
not just in the United States, but for pretty much anybody. Yeah.
On a global basis. And you said that a year ago, or a year and a half ago when we spoke, we were pretty much at 70% of GDP. And you had said that because of that, we can handle one more of these crises that we had in 2008, but not two more. And you had said that the U.S. is going to print itself to insolvency. They're not going to want to, but they have no choice because that's the risk retaken. How do you feel about, well, first of all, do you know where we are in terms of GDP compared to where we were a year ago?
Debt as a percentage of GDP, they have both grown since then, and we're still at about that level. Now, it is still growing. This is what Congress is debating right now, the debt ceiling and the rest of it. What has everybody concerned in the United States, specifically about the United States, is not the level of publicly traded sovereign debt, which is about half of our sovereign debt, okay, first of all. The other half is what we refer to as intragovernmental, the loans that are on
Social Security.
Social Security, Medicare, Medicaid, things along those lines. These are debts that can't be publicly traded. When I'm talking about debt as a percentage of GDP,
right,
we're talking about the debt that's public, the right, debt that the Fed owns, China owns, etc.
If you add in Social Security intra,
oh yeah, we're
at 180% or 500.
Depending on how you do it, right, you can arrive at a number of 200, 300, 400%.
Well, isn't the whole thing Social Security? We're ready. There's no money in it. It's all IOUs at this point, and.
Well,
not to get off on a tangent.
Not to get on a tangent, but this is an excellent point you bring up. You know, the President of the United States went on TV just the other day and said we might not have the money. This is a patent. This is a falsehood.
Falsehood.
This is a falsehood. Absolutely. The Social Security doesn't have a trust fund per se. What that means is, in the way that people understand it, the tax revenues come in to the Social Security system, and they are replaced by IOUs from the U.S. government. These are non-publicly traded, okay, intragovernmental debts,
sure,
but they are the equivalent to cash. What the President should have said is that I will have to start eating the value of the Social Security Trust Fund now in order to pay people, not that checks won't go out. Now, whether or not that's what he meant and he just did a poor job of explaining it, I'm not sure. I'm from Washington, D.C. I have a tendency to believe that that probably wasn't the case,
sure,
that this was a political maneuver on his part. Not trying to inflame anybody here, but it should be understood that the monies that are the Social Security Trust Fund is a liquid, not illiquid. It is liquid. There is the treasuries that are in there, the IOUs from the U.S. government, can be converted into cash at will. They are essentially cash.
So you had said, though, you know, maybe commercial real estate, maybe something else. You know, there is another crisis, and you talked about credit default swaps as a looming crisis, and you know, we'll get back. You know, in terms of that, you said it's actually, you mentioned it was actually the credit default swaps in other countries, which is the biggest. You said the credit default swaps right now, the market represents, just in the U.S., 10 times U.S. GDP, which is $14 trillion. And just tell me if I do a good job at simplifying it. From what I understand, a credit default swap is if you're a company and I want to invest $1 million in you and get bonds as a bond, I can go to my friend and say, will you insure the $1 million that I invested in him if I pay you $50,000 a year? He says, yeah, sure, I'll insure it. Then if you can't pay me back, he owes me $1 million, which is essentially what happened with AIG. Mm-hmm. And everything was AAA rated, but they said it was too much. And you said there's still $14 trillion of that out there.
People have, there's speculation of that size out there. What we're
not regulated.
That's right, and we're talking about the global derivatives market is about 10 times global GDP. Global GDP is in the range of about $60 trillion. About 25% of that is the United States. But of the sovereign debt, and the credit default swaps are not just for sovereign debt, by the way, as you point out. These are for companies, etc.
Sure.
And we don't have to get too far into it, but the derivatives that get created, these are essentially insurance products, as you say.
Yeah.
I make a loan to you, or you make a loan to me, and somebody else's, I'll guarantee. You know, and that's what a credit default swap essentially is. Keeping it simple. But yes, there are then derivatives on top of derivatives on top of derivatives. Now those are the notional values, by the way. That doesn't mean that's how much is really at risk.
Sure.
But these are people betting on all kinds of things, and if you add up the size of all of the bets, that's what it comes out to. The reason I bring that up is that it gives you an idea of just how, what the magnitude is from a regulatory standpoint, because a lot of people have said, we need to regulate this market.
Isn't this what got us into the mess?
How are you going to regulate this thing? You know, at some point you have to count on Jamie Dimon and that these guys
from
running
Goldman Sachs.
For the guys that are running the J.P. Morgan, the guys that are running are at least our top 20 financial centers, known as money centers. These are supranational financial organizations in many cases.
But they got us into this mess in the first place. How can we trust them?
You're right. You're right, and this is
got more money afterwards.
And not only did they get us into this, there's been
they didn't apologize.
They didn't apologize. That's exactly right, David. This is a real important point that these guys still haven't gotten.
Did you read Too Big to Fail?
I have, yes.
And there's obviously a documentary on it that was very eye-opening. You know, you're able to see every point of view. From what I understand, and then we get back to the insolvency, is it made me feel like Paulson and everybody in his team, and they were just guys caught, like they were doing the best that they could, and but also on the same side they're like, okay, well, we need, I don't know, 500 billion. No, let's do 700 billion. It almost felt like me and two business guys that I know trying to figure this out, and to some extent they were doing the best that they could, but on the other extent is, holy smokes, I can't believe that's how we came up with where we were. But that's the reality, I guess, of the situation. Do you think that's how it went down?
Well, I have dealt with a variety with the government in a variety of different capacities on very large transactions and structuring very large transactions. I was actually involved with the government before this whole thing blew up in creating bailout schemes for some of the regional banks around the country and raising hundreds of millions of dollars before there was TARP and the rest of these things occurring. We could see these things coming from a long ways out. By the time, I think by the time Bear Stearns went under, everybody kind of knew that we were going to have a crisis and that it was just a ticking time bomb. At that point in time, David, we were in the middle of a presidential election. Right. They wanted to try to get at least past that. Unfortunately, it didn't occur, and the whole thing blew up just before the presidential election. But at that point, you can't quantify it. I think you're dealing with, when I was in the Marine Corps, what we would have referred to as Kentucky windage. This is, if it's, like, we think it's going to be 500 billion, better make it 700 billion. The only problem I have with the entire process fundamentally is the banks should have been nationalized. And what I mean by that is, if we had to these banks were essentially insolvent for actions that they and some of their subsidiaries and the other non-bank members on Wall Street had taken. They should have seen it ahead of time. When they needed to be bailed out, they should have been nationalized. When I say that, I don't mean as in run by the government, but their assets should have been taken from the shareholders, and shareholders told, you did not manage this company properly, you did not manage your managers properly, and as a result, this equity is being removed from you. The banks would have continued to operate, and then the federal government could have reprivatized these to new private shareholders later and told them the same thing. If you bankrupt this organization and we have to bail it out, we're taking all of your equity as well. That's the only, I mean, you can debate about some of the other steps that were taken, but in my opinion, that was the biggie.
Well, because if you don't do that, how do you prevent it from happening again? And
it's moral hazard.
Moral hazard.
Exactly.
And so going back to the insolvency question was, you had said that the U.S. will print itself to insolvency in order to solve this crisis.
Yes.
It's just, here's my take on it. It was a very eye-opening experience to see this happen right in front of you. I'm across the street from the New York Stock Exchange, and the New York Federal Reserve is, to literally see $1 trillion printed and given out, and we had no power to do anything about it, and then given out, and you see all this money that's gone to Wall Street across the street from us, and you realize that this is not a free society. This is something to the effect that it's got to have a consequence. When it seems like we're just kicking the ball further down, because there's got to be a consequence. And by the way, no one wants to lower taxes. I mean, no one wants to raise taxes. No one wants to to lower what they're spending in the government. When are we going to give something and realize we're gonna have to man up?
I'll try to do this really, really simply. We basically have two ways that the government, from a financial perspective, interacts with the economy. Monetary system, this is done through the Federal Reserve. This is where we get to the Fed lowered interest rates, increased money supply, or raised interest rates to decrease money supply to manipulate or help to adjust whether banks are making loans or not making loans and the economy is inflating or offsetting deflation and things along those lines. The other is fiscal. Fiscal policy is what goes on inside the government. This is where you get to our income tax policy, our federal spending policy, budget, how money gets allocated within the government spending. So you got fiscal and you got monetary. We're obviously having this debate right now as to what we are actually going to do. But putting that debate aside, you got to remember, if you go back to the 1930s and even prior to that, I won't get into all of the economic philosophy that led up to it, but coming out of the 1930s, there was general agreement, okay, that in the event that we ever faced a situation like the 1930s again. I don't want to get into why the crash occurred and the monetary failures of the 1920s and everything, okay? Just that if we ever face deflation, a contraction in the economy actually shrinking.
Print money.
Print and spend. Print, spend, print, spend. And
it's amazing that Bernanke was the guy in charge because he studied this.
He did. He's an expert in it. And I don't think he actually thought we were going to actually be in the situation that we're in.
It's really weird.
But we're here. And the thing is, there was no plan B. Plan B is just keep redoing this again.
To some degree, it's trickled-down economics in a way where
Friedman actually is misunderstood. Friedman focused on the monetary side, spoke a little bit about fiscal. Keynes was big on the fiscal side, John Maynard Keynes. But Friedman actually waffled back and forth during his lifetime as to what type of monetary philosophy we should really use. But when what he finally came up with was that we need essentially a computerized system where money supply grew at a steady rate on a constant basis, which I don't agree with, by the way. Okay, that's essentially what's pretty close to the inflation targeting system that the Europeans have used, which has been an absolute total disaster. This is one of the reasons the Europeans are in the situation they're in.
We'll get to that in 1 second. Do you believe in trickle-down economics? Do you believe it works?
David, until this crisis occurred, and I wasn't caught off guard by it. I was on the radio 10, 15 years ago warning people about this even before it began, okay, which I won't get into. But I mean, and as we started ticking down, I kept telling people how this was going to play out. Fannie and Freddie were going to go, Bear and Lehman were eventually going to go. And as these things finally occurred, people said, how could you see it all ahead of time? And I said, I didn't have an ideology. I was trying to advocate for. I was just trying to look at the reality of the situation. Even having said that, David, I was caught off guard by the way we addressed this situation. The bailout of the banks, without in my opinion, was a corresponding return to the U.S. taxpayer, and I was even more caught off guard by the fact that the U.S. taxpayers did not let their congressmen know in whatever terms necessary that they weren't going to accept this. We just kind of laid down and accepted it. That's kind of getting.
You did a good job at evading the question.
Well,
because it's a political question in a way. It's hard to answer, I guess, sometimes.
It is. I'm a businessman.
Right. So
okay. I just wish the private sector would do a better job of policing itself and taking responsibility for its actions. I do believe that trickle-down economics, Reaganomics, supply-side economics, that the private sector does an excellent job of managing the economy on its own. What I also believe, however, as we've just lived through, is when they are responsible for a failure, they refuse to accept responsibility for it, which leads us into this kind of social dynamic where questions like does trickle-down economics work have to be asked. So it's a complicated subject, and I just wish, I think it would work better if we actually, you give somebody the opportunity to do something, and you don't preclude them, you don't pre-regulate them, but if they do something wrong, then after the fact, they have to be held accountable, and we didn't do that this time around.
Trickle-down economics, if I'm correct, is you lower, there's less taxes in the wealthy, and because of that, they're going to spend money, and that's going to help the lower income, versus, well, the wealthy raising the taxes, and that's going to help the economy by growing there. It seems like that's still a debate today, and it seems like that raising taxes is inevitable at some point. Because I was watching something on Jon Stewart, it was a couple of days ago, and it was actually a funny bit where he talks about every time the Republicans talk about Reagan, and they say even he raised taxes. We've lowered them so much. It seems like by adding more debt, it costs more than taxes, actually, because we're going to be paying off for a long time. But it seems like it's hard to not think that we're going to have to raise taxes to fight inflation that's going to be coming in the near future.
From a theoretical standpoint, the idea is sound, that if you lower taxes, especially on your most productive citizens, which are going to be your wealthiest citizens, that they will use the money more productively, economically, than will the government. In other words, you will get an economic gain, which will actually drive up real tax receipts, and job creation will go up, and economic activity will go up as a result. The problem simultaneously with that argument is, especially if we look at the structure of the U.S. economy post-World War II, there's been a growing migration of wealth to the higher end. More and more wealth is being controlled by fewer and fewer people. Okay, it used to be the top 10% and the bottom 90%, and then it became basically the top 1% and the bottom 99%, and it's very quickly becoming the top 0.1. And the bottom line is, and you see this reflected not just in that very high level, but the building of McMansion neighborhoods.
Sure.
The average size of a home in the United States has tripled in the latter half of the 20th century.
It's certainly not sustainable, and this is the first step to that.
It's not, and it's not productive. It's what we're finding is it might be a generational thing, David, but people are not productively using their assets to create jobs.
It just seems when I look at politics, and that's another show, but it just seems like when I hear them talking about, say, cutting $3 billion here, $2 billion here, and it's the social services programs that are being cut because they shouldn't be there in the first place. It just seems like all I keep thinking is we just printed $1 trillion and gave it away. Now we're talking about cutting this and this, and this affects people, and it just seems so not big picture.
It's count what you're absolutely right. All right, you're just right. This is going to be a big problem for the U.S. economy. It's a huge political problem now. Massive amounts of money. You don't even have to get into defining exactly how much it was between all of the programs, but as you point out, it's in the trillions of dollars. It's disgusting, quite frankly, that all of this money has been put into the economy through the banking system, which means at the top of our financial structure, the top of our corporate structure, into people that represent the top of our income and asset owners in the country, and none of it has gotten into the economy, period. And they then can't turn around and say, well, don't increase taxes on us, and better yet, even give us more tax cuts, which is another way of saying give us more money. So, wait a second, you haven't done anything with what's been given to you. Maybe what we should do is take it away again. And they can't seem to get through their minds that there's
yeah. Well, and the other question is, and it just goes, ultimate fairness. People are against nationalized health care because it costs more money. Of course, fundamentally, if it didn't cost anything, I don't think anybody in their right mind would say, yeah, if everyone can be taken care of and they don't have to worry about it, sure, that's a great thing. And so it's just again, it's one of those things where the cost they put to it still doesn't even come close to the cost that we just bailed out the trillions of dollars that we just put in there. And it just, again, it seems like we're not hitting the big picture where that's okay for one area, but for things that really can make a difference. And of course, now we're in a situation where we really can't afford doing certain things like that. So, look, and here's what I'll say. I'll take it back for a second. These are problems, and problems have to be solved, and we're the people. That's what we're here to do. So, I understand there's a lot of problems, and unless you're going to get on the front lines and help solve them and come up with a solution, don't just complain. And I can see both sides, and I just want to make sure I throw both sides out there because I hear it out there, and it just seems like there's no discussion. It's just talking points, unfortunately.
You're absolutely right. That's
the
all we're getting.
Version or the complex.
That's right. Talking points is the best way to look at it.
Yeah.
It's ideology, and I'm from down in D.C. Between the lobbyist organizations and the various organizations that advocate particular fiscal or monetary or tax policies or whatever, that's all you hear are these talking points, and very few people understand what's really behind them.
Yeah.
So
I've gone longer in time, and I want to go through a couple more things if that's okay.
Please, sure.
So what's going on today? We mentioned briefly the raising of the debt ceiling. Clearly, we're going to raise it. But again, what's your analysis on the fact that I think we've raised it in the past 10 years, like from 6 trillion to 14 trillion, something to that degree.
Yes.
How does this affect the country?
Well, let's go back to what we talked about a minute ago with respect to the sovereign debt to GDP. There's another aspect we didn't talk about, and that is tax receipts as a percentage of overall government debt. In either measure, we don't have to go into this in detail, the United States is nowhere near what the Tea Party is telling us is a crisis, okay? Nowhere near. We are nowhere near the Greek situation or anything like it, okay? We are fine. Now, the rate at which sovereign debt in the United States is increasing is clearly a problem. It has exploded since the Obama presidency, and I'm not placing the blame exclusively on him. This is much bigger than political ideology or Bush and all of the things.
Ron Paul's in office, it's going to be exactly the same.
Yes, that's right.
He's not ever going to be in office. So.
Well, Ron he's got his points, and he makes some very valid points with respect to whether or not we even should have a Federal Reserve.
Yeah,
but let's not go there at the moment. Hey, another show. Or unless you want to keep going with this one, I'm happy to get into that as well.
So sticking to the deficit.
Well,
the debt.
Right. Remember what I talked about as well, and that is that they only had this playbook. It basically was, again, presented to the United States by Milton Friedman at the end of, well, I shouldn't say the end of World War II, because we were so busy at the end of World War II just trying to get our economy going again, and we were lucky because we could. We weren't bombed out. We had the ability to convert our factories back from making tanks into making automobiles and selling them to the entire rest of the planet, okay?
Key, we had factories. We actually produced.
That's exactly right. And so we were doing this. And very few people wanted to question what the economic philosophy was. So it really wasn't up until around 1960 when Friedman kind of codified this idea that in the event that we ever faced the 1930s again, a deflationary spiral, print, spend, and keep repeating until it works. You've heard the statement, I'm sure, that inflation is everywhere and always and everywhere. A monetary phenomenon, which is widely misunderstood. What that means is, if you print enough money, inflation will be produced.
Very simple.
Right, and people think that means economic activity. The cost of goods will go up, and people will spend money, and jobs will be created. That's not what it means at all. But this is what kind of the ideology became. Economically and politically, you don't ever have to worry about anything financially. You don't ever have to worry about regulating banks again or doing anything, because if we ever face this crisis, all we've got to do is print money. Now the problem with that is, David,
I know where you're going to go.
The moral hazard.
Well,
if you tell people we've got the answer already, the banks and the financial structure is going to push to the point where that bailout is needed, where that has to happen. They can't do otherwise, and that's what we did. And then we've since implemented print, spend, and we've discovered, whoa, wait a second, this might not work.
Well, you got me thinking what the real bigger problem is, and maybe this, there's a dream that maybe there's one country someday, and maybe we'll get into that if we have time. But we have other countries out there, one being China, that our country is just like a company, and if we devalue the dollar so much and print, spend, China, who is our biggest debt holder, will want to take all their dollars and get rid of it. And they'll want all their treasury bonds or whatever it is. And isn't that part of the problem? Is the dollar right now is the reserve currency. And if our debt goes up and our dollar is weakened and we lose that, there goes the ballgame.
It's not really an issue until there's an alternative. And what I mean by that is,
They're trying, right?
the Chinese can grumble about the dollar, and anybody else who's holding it can grumble about the dollar. But if you look at the top holders in there, you've got, China's 1, Japan's 2, number 2. Right under them, you've got then England, Germany, OPEC, the oil-producing countries, and the Caribbean banking sectors is 5, 6, or 7 now.
So we have protection that if they try to move away from the dollar's reserve, everybody will go down together.
There's nobody's going to sell their dollars. U.S. Treasuries or assets in the United States, liquid assets in the United States, loans made to the U.S. or corporate debt tied to dollars. For the euro, for example, the euro is in a disastrous situation. The only other currency that's large enough to provide the liquidity where large blocks could be moved would be the yen. And look at the situation Japan is in. Japan is in a disastrous situation. So nobody's going to sell their dollars to go into yen. I'm not talking about traders. I'm talking about institutional holders. There simply isn't an alternative. The only other thing to do is say, well, then
there's got to be a breaking point, though. We can't go to. There's got to be a point where.
There will be. Okay, and that gets into where essentially Japan likely defaults, which if we have time to get into it, we will. It looks like it's inevitable there. The Europeans are going through their process now, and the United States will likely get there as well. People say, well, what happens to the point where we too will have a sovereign solvency issue, okay, just as Greece is having and Portugal is having and some of the other countries over in.
Just to jump on that one point right there, last year, you had said Greece was at 110% of GDP.
Yes.
You had said that they will default.
Yes.
Do you believe they're still on the path to default?
The only reason they haven't defaulted is
spending money.
Well, no, it is because the organizations that are in charge of figuring out how to handle the restructuring of their debt haven't been able to figure out how to do so. The IMF, for example, was charged in the 1980s after Mexico and Brazil defaulted on their debt, and we created the Brady bond system for bailing them out, which we won't, if you want to get into, we can. But at any rate, the IMF was tasked with create the rules for sovereign insolvency, sovereign bankruptcy, so that we have a plan in place the next time a country faces this, a large country. They didn't get it done. 1997, 98, again, my dates get a little mixed up once in a while. Russia defaults on their debt. So we didn't have a plan in place.
Might as well not happen. I don't remember.
Right.
So Russia defaulted on debt.
Russian defaulted on their debt.
In 1998.
It was. Let's see if I can remember.
At the time, I assume, or
no.
That was a long time ago.
97. Well, I think it was the Asian contagion, which spilled into 98's Russian default, which became the biggest hedge fund crisis in the world, which was the collapse of long-term capital management. So it was 1998. At any rate, the point was the IMF still hadn't created anything, so that they were retasked again. Go create a rule for sovereign insolvency. And then all of a sudden the situation with the European countries comes up, which you could see telegraphed long.
Sure.
You know, even before the euro was introduced, you could see where this was going. It was a blueprint. I was talking about this on the radio. It was the entire way the things they did there were just principally wrong, which again we can get into if you want. But the IMF never developed the rules. So now Europe is going through this situation, and they're quickly trying to figure out, okay, who's going to pay for it? That's what everything always comes down to anyway, all right? And by the way...
Is it Germany who's paying for it mostly now?
Well, quite frankly, in my opinion, what's really being worked out here is the U.S., right? How big a piece the U.S. is going to have to fund, which means... Look, there's a big backstory here. Every time you see something like this, what you need to ask yourself is who makes out, who wins. There's going to be a sucker that pays, and there's going to be a winner. In a situation like this, from an international institutional standpoint, the IMF is what they're advocating is creating a new super currency, a reserve currency that replaces the dollar.
World order.
A new world order. Yes, absolutely. And those aren't,
those are real, you're saying.
Oh, yes. It's king of the hill. This is the nature of mankind, is to move in this direction where you get these superstructures that are built up above countries and things like that. We're 200 years into this entire process. And it's king of the hill. This is the way Wall Street works. It's the way everything works. But the IMF is trying to capitalize on this problem in Europe by using its what are known as special drawing rights, SDRs, which is again, I don't want to get into it in detail, but they want to use that as a reserve currency to replace the dollar. Okay. The problem is the IMF exists principally because it is funded. The biggest funder of the IMF is the United States.
So the IMF is bailing out Greece?
Well, there's a series of institutions. You've got the European Union itself, the political structure there. They don't have a fiscal collective, so they've got to go to all of the individual governments, Germany being the largest, okay, from a fiscal standpoint that will provide money.
Let me ask you this, though. How, in your opinion, how will Greece default? How do you see that playing out if you can...
Well, first of all, it's not just Greece.
Which will lead to other Eurozone countries.
Whatever is developed for Greece, for managing the problems with Greece, is going to quickly be applied in
Italy having problems too?
Well, yes, there are many more problems. In general, the way it's been referred to, Goldman Sachs refers to them as the pigs, P-I-I-G-S, Portugal, Italy, Ireland, Greece, and Spain, okay? Now, generally, these are the southern countries in Europe. So what's being debated now is the northern countries who have been fiscally responsible, let's say. I don't want to, it's not even a good use of the terms because the north has generally loaned money to the south so that they could buy the north's goods, principally, again, Germany's goods. And it hasn't worked out real well. So it's being billed as a north-south divide in Europe right now, with the north wanting their money back and the south saying we can't pay. However, beyond just those countries, what's not being talked about in the media at all, and this is very important, is the eastern countries, the eastern members. You get to Latvia, Hungary, Slovenia.
They're too hard to pronounce. Why talk about
right. That are members of the EU, some using the euro, and some that are still using their own sovereign currencies but are supposed to be transitioning to it. The structure of their economies does not work within the Union itself, although they are members. And as we're seeing this debate between North and South, who's going to pay for Spain to default and Portugal to default and Italy to default, you could start seeing the eastern countries either leaving altogether or worse, joining up with somebody else.
Sure.
Russia, for example, or the Chinese. And this is something I'm dead serious. Nobody wants to see this happen. But they're not discussing it. It's
called the end of the West, correct? When China and India and Russia combined.
That's exactly right.
I'm quoting you. So.
Oh, you are? Did I talk about that then as well? Okay. You see, I didn't remember.
That's how smart I am. I quote you.
There you go. Yeah, Zbigniew Brzezinski, who was Carter's national security advisor in the 1980s, outlined this in a book, which is a fantastic book on the subject called The Grand Chessboard, where he discussed that principally the United States' role over the past, especially since the end of World War II, has been to keep China and India apart. Because if they could ever join economically and then get the stands and the Caucasus and the Eastern European countries to move over, they could create this vortex where they suck in essentially everybody else. And then the other leaders of the world that we're most familiar with, the Western countries, Western Europe, the United States, Canada, Australia, Japan, cease to exist. Because 2/3 of the population is right there between China, Russia. Most of the world's natural resources are there. I mean, they can just look at themselves and say, you know what, we don't care if the United States, Canada, Australia, Western Europe even exist. So this is something that's very important to understand, and this is especially right now with respect to what's going on in Europe. Nobody's talking about the eastern countries and what their needs are. And so that they're talking about this north-south divide, which again has been going on. We had this discussion, what, a year and a half ago? Year and a half ago. And they keep kicking this can down the road and not coming up to it and fighting and fighting and fighting. And I think they're going to wake up and realize that before even if they do come up with a system, it'll be too late. The EU will have dissolved underneath them as all of the other countries have left. And you're left with the Western European countries kind of staring at each other. We've saved it, but it's not worth saving after we're done.
Do you think we're talking a matter of years at this point? know it's hard to give numbers because
I'm amazed.
How fast can you kick it?
I'm amazed this has gone on as long as it has. Because you could see this thing 10 years ago.
After you spoke, I was convinced the next month. Because after you spoke, literally, I saw headlines on talked about Greece needing, the week after, a year and a half ago, Greece needed $150 billion. Another headline, New World Order, Obama is moderating and adding and helping the Greece debt. Madrid is downgraded. Danger looms in the Eurozone. This is a year and a half ago, and it kind of then died out, and now the headlines are kind of back in a way. Let's talk, we have about 15 minutes, is that's okay?
Certainly.
China. The growth, you've said it, and I've heard it many times, the growth is unsustainable because it's impossible. If they, by what you had said, by 2020, and I'd seen this before, they will have, if they keep growing, they'll need as much oil as the U.S. at 12% a year. By 2030, they will have need as much oil as the entire world, and by 2040, they'll need more oil than the world. So something's going to change. It's going to happen. So what do you see happening?
You know, since we last had this conversation, again, a year and a half or so ago, China has realized it's got an inflation problem now. In Shanghai, for example, a couple of months ago, there was a trucker strike. Truckers went on strike because they couldn't afford to put fuel in their vehicles. This gets to recognizing that you've got social unrest as a result of food prices going up and energy prices going up, and it's not just in China, it's all over the world. But for the time being, well, let me just divert this conversation. If one of the things that has occurred since the last time we had this conversation is all the social unrest going on in the Middle East. Okay? All of this social unrest around the world is really predicated on food and energy prices going up. Yeah. And that's a reflection of global depreciation of currencies, the dollar being pushed down by the Fed flooding the market with dollars, the ECB flooding with the euros, although not nearly to the extent that the United States has, and Japan doing the same thing. So all these paper currencies are being pushed down. The banks that are getting them, again, it's not just in the United States, it's everywhere, are taking it out and swapping it for commodities and stocks and bonds. And
assets.
So the people who have these assets, yeah, they feel good. But if you're a consumer of the assets and not an owner of the assets, if you're not rich and your money is being used to put food on the table, and most of your money is being used to keep yourself alive, roof over your head, food on the table, gasoline in the car, you're seeing all of your costs go up, and this leads to massive social unrest. So this is one of the things that's occurring in the Middle East, other parts of the world, and it's clearly begun now in China, and they're trying to offset it by pushing their interest rates up and trying to slow their economy down now and slow the inflation rate in China. The question is, can they do it without having a collapse? And a lot of people are calling it a hard landing, and I'm saying, well, that's, in my opinion now, I think that is charitable, because at least it denotes a landing. Okay, I think if China gets this wrong, and I've worked with some of the leaders in China, that China's economy and the entire political infrastructure that goes on there, a concept known as the mandate of heaven, which is that you get these competing political factions that are built up over several generations, competing with each other, that we don't have in the United States. If they don't handle this properly, you could see this kind of a cascading process, a vicious spiral occurring. Now, even the people that believe something like that will occur are thinking that it might be contained to real estate, say, in Shanghai and some of the other areas.
I assume they're still not at 12% a year at this point, or maybe they are.
No, they're growing at just under 10% right now. Their numbers just came out. Their annualized rate of growth, GDP growth in China right now is about 9.5%.
There'll be a point where I assume sooner than later, they're not growing at all, or they're growing in the single digits very soon.
If the inflation keeps going, they won't be growing in real terms. But this gets to that problem. There's a point at which you're getting growth if it's being offset by the cost of goods going up. It's not really. It's harming your economy. It's harming your citizens. So they've got to get it under control. In
simple terms, because in the United States we are concerned about what affects us. How does this affect us, the United States?
It affects us in many ways. First of all, both positively and negatively. The Chinese miracle is not because of China, per se. It's not as though they all kind of...
Miracle meaning how big they're growing?
The rate at which they are growing. Okay, that it took capital to make this work. The capital that's driving China, has driven China, comes from the West. And when I say the West, we're principally talking United States. It's called U.S. foreign direct investment. U.S. foreign direct investment in China is the capital base upon which all of the growth in China is based. And there's huge problems with that because Western investors put money into China, and then it's not as bad as Russia, but it's pretty bad. They discover that their investments are stolen from them in some capacity. Or so there's a lot of growing distrust.
But I'm saying to the individual.
Well, if China gets this wrong, this is what happens. Okay. It's like the Mississippi River flowing in reverse. All of the money that's been flowing into China, if they screw this up over there in China, as they're trying to control their inflation issue, what they may very well do is have the money that's been driving their economy start moving back out. In other words, the Western investors that have gone in might start saying, "Uh-oh,
I'm just confused.
We're going to move back to the United States."
And this is why I guess people don't have these discussions, because they're really confusing. But if you're saying money, they're being driven by money given to them from the West, and our economy is being driven by money they give to us in debt, and then we give them treasuries. Whose
Where's this private money? Okay.
Okay.
Private money is moving to China. You know, we're taught that
private money, which comes probably from the Fed to some degree.
Well, it's
just a weird circle.
In some capacity, it does right now. Yeah. Okay. But by and large, we're talking about private investors. Now, one of the things we're told is that private investors have moved their money from the United States into China because of a labor arbitrage. It's moving of factories.
Sure.
Closed my automobile factory in Michigan.
Outsourcing.
Yeah, right.
It's a big problem.
But that's not all. The big growing issue here, which is something we have to address in this country, is that Bill Gates is, he's a big investor in what's referred to as fourth generation nuclear energy production, which, again, I don't want to get into. But the point is, he's not doing this in the United States. Okay? He's doing this in other parts of the world. And he's planning on building these things in China, because in China you can do this. They don't have the same regulatory oversight. You can do something in a week that might take 3 years with regulatory approvals in the United States. So that what we're now seeing dangerously is it's not just move my rubber ducky manufacturing facility to China. It's moved my research and development facility to China, because I'm going to be able to develop drugs in China more quickly than I can in the United States. I'm going to be able to do all kinds of things there. And that's very good for China, and quite frankly, it can be good for the whole world from a consumer standpoint. But we need to look at this and say, people are going to China more or less out of a reaction. It is a reactive decision. It's not a proactive decision. It's not, go west, young man. You go to China, land of gold. Okay, it is the United States has regulated itself into oblivion. And we need to back up and realize, wait a second, we have really got...
So we've regulated ourselves to oblivion?
Yes.
In certain areas.
All kinds of areas in the United States. Except the financial markets, yes, that's exactly right, unfortunately.
It's not only that, it's also that...
it's saving the spotted owl, and there's nothing wrong with these things until
employee cost is very high, too. It's just...
Absolutely.
It's at $3 an hour versus $35 an hour. I mean, we won't get into it now, but that's certainly
the labor arbitrage component. But it's quickly becoming,
the auto industry. Certainly, that's a big part of their labor costs, their pension costs. I think we have a few minutes left. Michael, I guess, will tell me in a second. Is peak oil? That's something you've talked about a lot, and I hear a lot. Is peak oil is when you can't produce any more oil, and then there's less oil being produced every year from there. Is that peak oil? And how does that
Well, there's a number of different terms. Peak oil is a kind of a blanket term that's used to describe when putting aside how efficiently we use oil, that our access to it, that we are at the point of depleting the known supplies. Okay, now traditionally throughout history we have always discovered new supplies of oil. And we've created in the United States, for example, CAFE standards, which means make cars go longer on a gallon of oil. So we're using it more efficiently. And that deludes us into believing that this is never really going to be a problem. But the big issue here is that we haven't found any major supplies of oil anywhere in the world in about 40 years. This is why we're doing deep water drilling out in the ocean, and why we're looking at turning shale into oil. And
let's say we can't, and peak oil happens. That means once you hit that, every day there's less oil left than there was before.
Yes, right. Which means no matter how efficient you are in using it, eventually it's going to run out and will need to be replaced with something else.
And I mean, that's clearly a game changer.
It is.
You know, talk about costs going up in food. The amount of food that's used, oil that's used just to produce our food. And I mean, that's just one part of it. But if that's really the case, what do we do?
Well, oil, first of all, is principally used, almost exclusively, quite frankly, for the creation of fuels for internal combustion engines, right. Gasoline, diesel fuels, etc. Okay, so the question becomes, what are we going to use to replace gasoline and diesel? That's what the real question is. Right. Okay, and we can do that. The electric cars for urban travel and natural gas-based vehicles for overland travel, for city to city and things along those lines. Buses, you see buses in the cities that are, natural gas and things along those lines. That's always been the question. But there's a puzzle here. It's okay, if oil goes away and we can't have gasoline, but we can replace natural gas, and we can do it. Quite frankly, it's a very simple thing to do. We could do this in 10 years if we wanted to. I mean, really. This is a lot easier than putting somebody on the moon. Yeah. And it wouldn't hurt anybody.
Seems like it should
It's
be.
a real simple thing. The question becomes, well, natural gas is used to create electricity. So what are we going to use to create electricity if we migrate natural gas? You know what the answer has always been?
Solar?
Nuclear. And then this giant wave hit Japan. And now everybody's kind of, like Homer Simpson.
Solar, though. I thought solar was I mean, if the technology exists.
Oh, we're talking about right now. Okay, solar's growing and it's getting more efficient.
Today.
Okay, but we're talking. You cannot replace our existing fossil fuel energy infrastructure, both the creation of electricity and the creation of fuels for vehicles, with green energy. We don't. It's nowhere on the horizon. It will eventually be there.
It has to.
But how do we cover the gap?
Moore's law will get there.
You're right. Eventually we will. Yeah. But it's going to take a lot more time than it appears we have right now. So
Me and you, at least.
The bottom line is, it looks like, for all of the griping that's going on around the world with respect to what happened at Fukushima, is in Germany canceled their or has begun their plans to shut down their nuclear plants. This will all go past us in the very near future, and nuclear is going to have a renaissance. It'll be pushed off now in the we'll wait to see whether or not we transition towards thorium-based systems, which are generally safer. That's the Generation 4 stuff that Bill Gates is working on. But nuclear is here. Kind of the peak oil is going to force these issues, and
it has to be done.
It has to be done.
I myself, I'm an optimist, and we've talked about a lot of dire things, and I'm sure you go throughout time, you can recycle, and there's always dire things going on, and that's why being an optimist is the way to get through it. We actually have come to the end, and I want to give you a minute or two just to kind of give us your optimistic hope of what our next steps are and how we get through this and where we go with the economy. Give you the last word on that.
One of the things I would say is, especially in the United States, putting aside the rest of the world or Western civilization, just the United States itself, it's a fascinating culture. People come here because of opportunity, because they want the challenge. They see the invite. This has been going on for hundreds of years now. Every time we face a challenge like this, where some of the people who don't want to get up and get dirty and get down to figuring out where the opportunities are will tell us the U.S. is going to come to an end, Western civilization is going to end. And there's another saying, and that is that it's always darkest before dawn. One of the things I've been telling people as I go out and lecture, and I'm not I am not, as you're aware, a motivational speaker. I kind of try to speak from a reality standpoint, but I see things differently. Negativity is positivity, and what I mean by that is, when you see in the paper that articles like one of the guys I work with or write with, he writes for another publication, but he recently wrote an article, David, entitled, "I would rather shoot myself in the head than buy another home." I had to go out there shortly thereafter and talk to a group of real estate agents, and I said, that means you're at the bottom. That's what you need to understand. When we start seeing headlines, the United States is going to default, Western civilization is going to fail, this is the end of the American century, you know you are at the bottom. Now, the last step in acknowledging that is the hard part. When people actually become convinced real estate is never going to go up again, the United States is never going to go anywhere again, that's when you seriously need to look at it. That's when you need to get in. The negativity at that point is at its maximum. There's nobody left to become more negative. And it's up from there. And I think that we're on the verge of that occurring. I do believe that the equity markets in the United States are going to roll further to the south, as I think will happen in the rest of the world as well. Might not, but I think it will. But at the same time, I'm telling people that in my opinion, I think we're near this kind of secular bottoming process economically. The fight going on in Washington right now, all of these things I look at as very positive events. Sure. Because they mark a fulcrum, an inflection point, George Soros would refer to it as. And so I guess I'll leave it at that. I don't like the rosy outlook because then I get nervous. If I can see everybody being negative, that's when I get to be the most positive.
And I'll say knowledge is power, and I really appreciate you taking your time and sharing there's so much insight in so many different areas that we've covered it in this hour. It helps us be more optimistic because we understand what's going on. At least when it happens and you just hear the sound bites from the media, you know the backstory. And I hope next year we can do this again and see where we're at, and hopefully, we don't have the dire headlines. We will, but we'll have optimistic things to talk about as well. So Roger, thank you for taking the time to watch and sharing with us your thoughts. And once again, thank you for watching Lawline, and we'll see you next week.
You've been watching Lawline with your host, David Schnurman. Mr. Schnurman will be back with you next week at the same time. If you have any questions about this week's program, please send an email to info@lawline.com.